Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, we are continuing our series where we will be discussing some current news and things we are reading or doing.
That's correct.
Doing.
Done. Had happened to us.
It already happened.
Yes.
So, we each have a few different things we're going to be talking about today. Josh, why don't you go ahead and get us started?
All right. And instead of articles or books or things I've been reading.
Because you didn't read anything.
I don't read at all anymore.
You don't know
again.
how.
I'm going to talk about 3 highlights from a conference I attended just recently. I'm part of NAPFA, N-A-P-F-A. It stands for the National Association for Personal Financial Advisors.
So it's like if you were to take a nap, you're a napping financial advisor,
That's really what I am.
N-A-P-F-A.
Yep. Really what it is, it's a group of advisors who they all have to have passed their CFP. That's one criteria. The second criteria is you have to be a fee-only advisor, and so you cannot accept commissions or anything like that.
Which we would say is the best.
So that's the group I'm a part of. It's a great organization. They actually hold advisors to a higher standard. I have to get continuing education above and beyond what my normal is, and they have some ethics and rules that you have to apply by. So it's a great organization. Love to be part of it. They'll host these awesome conferences, and this is back to in person, so it was nice.
After a year off.
Yes, and what was great about this is they bring in speakers for this continuing education, but they also have time for like advisors to get together and talk through problems and issues. So I got 3 different highlights of some of the stuff I learned in that conference. First one being...
Please tell me it's the lobster roll.
Lobster rolls. So the conference was in Boston, and I tried my first lobster roll, and it's expensive and really good. Yeah, they cut it in half, gave me 2 different versions. So good.
This picture you showed me.
It's expensive, but good.
I would spend the money right now because one was butter, lemon, garlic, and then the other one was like a salad, like a lobster salad with mayonnaise.
Yes, so good.
Oh, man. Making me hungry.
So I learned that's good, but I also learned long-term care. We've talked about that in the past. It's
LTC.
Exciting. Yep. LTC.
I was reading through the note in advance, and I thought you were talking about Litecoin.
Oh, no. This is not Litecoin. Long-term care insurance is insurance you buy for long-term care, meaning care when I'm in a facility or at home needing extra help. And so it's expensive. And the issue that they were discussing there is in the not-so-near future, we may see the government initiating new taxes to, in a sense, cover or provide long-term care similar to what they do for Medicare, Medicaid, or Social Security. Mm-hmm. And so they brought as an example to this that actually the state of Washington has already proposed this. In fact, come early November, in the next couple, weeks, the eligibility period is closed for you to opt out of this thing in Washington. But in a sense, the state of Washington says, hey, we're going to charge a 0.58% tax on your
top
wages,
of what you're already
on your
paying.
income. This is a new tax addition to. And this tax we're going to collect, and it's going to go into this bucket, and it'll be to provide long-term care coverage for everybody that's in the state of Washington that qualifies.
Right.
So they have a couple rules. You have to pay in for 10 years to be eligible, at least 10 years. And then once you're done and eligible, you get $100 a day for 1 year. That's great. That's awesome. It's not a lot.
No, that sounds like a terrible deal.
So we're recording this in Ohio. We're in kind of I would say a lower cost of living area.
Yep.
But what's projected right now is about $250 to $300 a day for long-term care coverage for our area. We're in a low cost of living place. It's higher for state of Washington, where this is, or other places. And the average stay is about between 2-ish years or so.
Yeah.
And so this coverage that you're forced to pay into really does not fully cover you, even for 1 year worth of long-term care. So I think still people are still going to need to get their own coverage to supplement this.
Right. But
So-
people won't because they think they already have it.
It's
That's
like
how it's
a lot
gonna
of other
work.
things is,
Yeah.
I got the coverage, I'm okay, and they don't
Yeah.
look at the benefits. So just something to keep in mind. Along with this, there's actually about 4 other states that are looking into doing something similar, and there's a bill in Congress that would make a federal tax.
Is that part
type
of the
thing.
big, gigantic
Nope,
bill?
it's separate one. It's actually proposed a little while ago, but it's just been kind of hanging around. Hasn't got much traction yet. Probably won't see the light
Probably
of
because
day
the
this
math
year.
doesn't work.
It's rough. Now, I will say, at least something. I mean, that helps because what that does is takes the burden off the rest of your investments, at least for a while. It really, 0.58%, I mean, if you look at on like $100,000, it's not like going to drastically change your take-home pay.
Right.
But for what you pay in, let's say for 30 years and what you get for this,
Yeah.
it's really not a great bang for your buck.
Well, it's the same thing as Social Security.
It is.
Social Security's math doesn't add up
Yeah.
either. That's why it's,
Yeah. And with it, it's like a public-private collaboration. So although the government's charging this tax, you would actually be private insurance companies would be the ones actually providing the
Oh, yeah.
coverage. So
Gotcha.
it's a like kind of a combination between the two. Anyway, long story short, it was very interesting, but you still need to consider long-term care insurance, whether it fits for you, and you need to understand if this is coming down the road, maybe I need to adjust my insurance. Maybe I actually will have too much if I qualify for this, or if I want to opt out and have my own plan where I'm going to save money. It's worth looking into something new.
Yeah.
Interesting.
Well, I, unlike you, actually do read
Oh, man.
because I remember how.
Yes.
But, Josh, I mustache you.
Oh, man. So this whole time we're recording, if I seem distracted, it's because I'm looking across the table. We record facing each other, and Austin's facial hair has taken a drastic change from what I'm used to seeing.
It's dramatically improved.
The jury's out, but he has a mustache now. This morning, walked in, first time,
Josh about turned around.
and I said, I don't know if we can record today with me staring at this, but I'll do my best.
That's right.
But you have a question.
I do. So how many cars, specifically Tesla Model 3s, did Hertz put an order in for that was announced today as we're recording this on the 25th of October?
When I think of rental cars, I do not think of high-end electric cars. So how many did they order?
100,000 next year.
Oh,
by through
for
next year.
So
well, between
from now
and
through the next
yeah.
year. How many cars does Hertz have in total?
That's what I'm wondering.
That's a lot of
That's
electric
a
cars.
lot of electric
Because
cars.
that's like the high end, right? If I'm looking on my list of things to rent from Hertz,
It has to be a
there's
premium.
like like compact and
Yep.
sedan and then minivans
Right.
and SUVs, and so the premium
gonna be a premium.
100,000.
They are ordering 100,000 Tesla Model 3s. Now that is the lowest level Tesla.
Oh yeah, they're junk.
They're only well, I guess it's a $4.2 billion order estimated. So 4.2 billion sounds
Do
like
the
about
math.
$42,000 a car, which
Maybe
so,
they're getting a
so
group
Hertz
rate.
seems like they're getting a group rate.
possibly.
But if you think about it, like that's a chunk of Tesla's production. So I looked at this a couple different ways.
Yes.
What does this mean for Tesla?
Yep.
Well, today alone, now again, we're recording this on the day it gets announced, the 25th of October, Tesla stock is up over $1,000 per share, and around $955 or something like that was the break-even point to hit $1 trillion in market cap.
So they're over $1 trillion.
So Tesla is now over $1 trillion in market cap with a share price over $1,000 per share. That's a lot. And up 10-13% depending on when you're looking at it on the day of the release. So that's huge. Also, kind of over the weekend, Tesla Model 3 was announced as the best-selling car in Europe,
Wow.
which is the first for a non-European car company.
That's crazy.
That is crazy. So one of the thoughts that's kind of letting the bulls bid the price higher on these shares of Tesla is that Tesla could get recurring revenue as rental car companies tend to purchase new again after a couple years.
Yeah, they tend to rotate through
Yep.
and sell off their cars. Yeah.
Now, one thing to factor in is it might not be as frequent. With electric vehicles specifically, the cost of ownership and the maintenance requirements are generally lower. So that could be something to factor in, but it's sending the shares much higher. But you also need to look at it from the other side of the situation. So what does this mean for Hertz? Well, first of all, I'm a little bitter about it because I drafted the bankrupt Hertz company in my stock draft, Invested Ad stock draft,
Yep.
which you can still join today.
That's right.
Fresh $100,000 for the last couple months. Beat Josh.
Probably.
But I lost my shirt because while in the real world, you would have gotten real Hertz shares once they came out of bankruptcy. In the fake game world we're in, it just gave me $0 purchasing
because
power.
it didn't do the transfer.
It didn't.
Yeah.
and they won't fix it. So
Nope.
I'm a little bitter about that.
You're still kicking butt most other people.
Still doing okay. Still doing okay. So anyway, what does this mean for the company? Well, the company just came out of Chapter 11 bankruptcy, and now somehow has accumulated the ability to finance $4.2 billion in cars.
That's crazy.
Like within a year.
Where did that come from?
Within a year, they went from we can't even pay our bills to hey, someone believed in us enough to give us a bunch of
money,
cash, and now
buy Teslas with it,
or ability to borrow.
Yes,
and now we can go buy 100,000 Teslas. So what this means is that the rental business must be booming.
It is,
which it is. I traveled some this summer, paid an obscene amount of money for a rental car.
Yeah, rental car costs are just crazy
it's
right now.
Crazy. Another thing is that the EV charging station network is going to need improvement with 100,000 more rental cars. Like you're renting a car. Right. You need to take it. Do you still need to take it back with a full charge?
Oh yeah, how's
that work? So like, we're going to need a little bit of work. The rental EV stations, and I think that that's something that was planning. I don't know about on amended versions, but was planning to be in some portion of the infrastructure bill. That's who knows the status of that on a day-to-day basis. And another one is this is a cool opportunity, and I might even take it if I go rent a car to try a Tesla. Just try one.
That's true.
So if you want to try a Tesla Model 3, you can just rent one from Hertz and take it around for a couple days, and there you go.
Sounds good. I like that.
That is my article number 1. All 3 of my articles are going to be linked in the show notes.
And mine are experiences that I had, so no link
to me, your brain, Josh.
To my experience.
What is number 2?
All right. So another session I attended that I really enjoyed, and it's extremely boring probably to some people, but it was exciting. Just recently we had a change to how when people inherit IRAs, and we've talked about this in another episode, but when you inherit an IRA, there is now a 10-year time frame that you have to get the money out of an IRA. Whether it's a Roth IRA,
this
I know
is
it's
boring.
Right. I'll put everybody to sleep. But the concept there is you used to be able to stretch it, right?
Yeah.
If I inherited an IRA before 2020, I would be able to say, okay, for the rest of my life, I'm going to take a little bit out per time, those required distributions, but it's based on my life expectancy. The government changed the rules. The IRS now says you have 10 years from the year after the death to get all the money out of that IRA. And so what that does is it shortens that time frame, because if let's say I'm 20 when I inherit an IRA and my life expectancy is to 80, that gives me 60 years to get that money out. Now I have 10. So it really
much shorter
compresses those taxes too, because every distribution out of a regular IRA is taxable. And so for 10 years, I got to figure out how much I want to take per year. There's no rule. You could do it all in the last year. You can do it a little bit per year, whatever you want.
You'd probably look at your tax brackets and play that game.
Yeah, so the concept is, what do you do with these new inherited IRAs? So there's some concepts that they're talking about, one of which is making sure that, let's say I'm 55 when I inherit, and I know I'm going to retire at 60. Well, I could not take any withdrawals those first 5 years because I have income, and then when my income goes away, take distributions for the next 5 years to reduce the overall tax burden.
Right.
There's strategies like that. But what they were talking about in this was a pre-planning before the deaths of things that you can do. And I'm not going to go through all of it, but a couple just to highlight is one is you do split beneficiary. So let's say it's a husband and wife, and together they both have some IRAs and accumulated wealth. And they say, you know what, if something were to happen to one spouse, the other spouse, they're financially well off that they don't need all the money. You could make the IRA like a 50-50 beneficiary, 50% to your spouse, 50% to, let's say, the kids. So if you were to pass, half the money goes to your spouse. She can still live on it. She could take it as her own IRA, so she has no 10-year rule.
Right.
The other half goes to the kids, starts their 10-year rule, but only on half the money. So it's less taxes on them. And then when the second spouse is to die, that money plus whatever she had, but that money is then starts a new 10 years. So you're stretching those by creating multiple 10-year windows. Just something interesting, again, it comes down to planning and working through what works best for your scenario. That's one. The other is to keep charity in mind. So, when you give to charity through IRAs or just in general, there's no tax involved. And so who you name in your estate can really adjust that. There's things you can do before you pass away in giving to charity where you can create certain types of trusts that once a certain time frame is done, that either the income goes to the beneficiaries during that time frame, or the lump sum at the end goes to the beneficiaries and the charity gets the income. There's all these different fun things you can do tax planning wise, but those are some things to look into to say, can we move some other assets out of the estate to offset some of this tax burden that they'll experience? So long story short, more planning is needed, especially if they reduce the estate tax limits. Right now it's over $11 million per person, 22 for a couple. They're thinking of moving it down to $6 million per person or 12 for a couple.
That's a lot lower.
Yes, it's cutting it in half. It's going to cause some issues, especially when you look at maybe if you own farmland or property, things like that. That all's added into your estate. So long story short, planning is key. Thinking through the things before it happens. I can't tell you how many times I read articles, going back to reading. I do read
he does
every
read
once in
a little bit.
of famous celebrities passing away without even a will, and everything just goes into probate. Where were the people around them that was supposed to be helping them plan these things?
If you are a famous celebrity with lots and lots of money,
have at least a will,
and you don't have anything. We don't do wills, but we know people who do.
Yeah.
And we would love to help you.
Oh, geez. It's just the concept of that. I mean, it all
Invest with
becomes
us.
public.
Check it out on our website.
It all becomes public knowledge is the crazy part.
That's crazy. So, Josh, you have something else for me?
I do. I have a dad joke.
From?
It's from Reddit. Yeah. You had to help me figure out how to work Reddit, but I figured it out, and I'm good to go now. The dad joke, though, relates
You went to the library, and you're like, can I find a newspaper from Reddit?
I need to read a Reddit? So, you were talking about Tesla.
Yeah.
Do you know why Teslas are so pricey?
Well, it's proprietary electric vehicle technology. It's premium.
Austin, this is
of course it is. Oh, then no.
Why do Teslas cost so much? Because they charge a lot.
They charge a lot.
Because they're electric vehicles.
Well, of course.
That's why.
So here's a question. You know how you plug in your phone every night?
I don't, because I have a Samsung and it lasts longer than that. Go ahead. You probably plug it in every night.
I plug my phone in every night.
Yes, go ahead.
So you have a Tesla. You have 350, 400-mile range in some of the high-end stuff. Like good range. Do you charge it every night just in case, or do you not?
I would have to ask them, does that affect the battery life?
Because I think it's better if you plug it in and leave it plugged in, but have a setting that doesn't overcharge it, but leaves it.
That's built in, right? That's got to be built in.
It has to be.
It's got to be built in.
Otherwise, those batteries wouldn't last very long.
Yeah.
So I think I would probably be a
I
plug-in.
would always plugged in just in case I got to go somewhere a long ways away. Just in case.
My 1 mile to work. So anyway.
So if you only drove it to and from work.
Oh, yeah.
How long? Like a year.
Like a year?
I charge it once a year. Man.
I tell you what, I could be a Cybertruck guy if they were affordable. Like if they can make a Cybertruck that is
$10,000.
Yeah, that's as affordable as a used Honda Pilot. Oh,
I'm in.
Sign me up. There's a bunch of polls like on Twitter and stuff that are, what is the thing holding you back from going electric? There's no electric cars that are nice and reliable that will cost-wise be even in the neighborhood.
Right. And long distance travel, I still can't get around that.
The charging network's not there.
Just even the timing and convenience of getting from house to vacation with 4 kids and doing it in the most time-efficient way. Because the longer you're in the car, the grumpier people get. And so if I'm charging for 30 minutes, even on a supercharged thing, that's 30 minutes.
What I don't understand is why it is so difficult to get a vehicle that charges on its own. Like, think about this. They use this technology exists. Energy recovery.
Momentum?
Yeah, so energy recovery. Yeah. So
braking.
Tesla, listen up. Just get this together. As you're braking, you can harness the energy. As your wheels are turning, at any point in time, you should be able to run some sort of prop off of that wheel turning inertia to charge the battery somewhat. So
I don't know.
If I just cracked the code for electric vehicles,
you would think
I've made them self-sustainable.
Yes.
They don't even, you never have to charge them.
You put a wind turbine on top, and as you move and the wind spins the turbine, you charge your battery.
But I seriously think the solar panel roof thing's a real deal.
Oh, yeah.
That has to be a thing. Like solar panel, the whole top of your car. Mm-hmm. It has to be.
I've seen those. I mean, they're not like Teslas, but they're very small motored vehicles. Yeah. But yeah, you're right.
So anyway, I'm saying there's room to work. Tesla, if you're listening, I got you.
Yeah, you got
Give me a call, Elon. Give me a call. We'll do a podcast.
Yes.
We'll have you on. So my second article is titled Nobody Wants Cash Flow from the Irrelevant Investor, which we're maybe we want this to be relevant, but he has a funny, catchy title for his blog. But it's Michael Batnick of Ritholtz Wealth Management, and he's one of the co-hosts of the Animal Spirits podcast, which a lot of people listen to. We've listened to quite a bit. It's pretty good stuff. So first of all, his colleague and co-host of the Animal Spirits podcast, Ben Carlson, we did an interview early in our podcasting careers when we talked about his book, Don't Fall For It. So we'll link that episode in the show notes. Check that out. But in general, this article was talking about how there are actually 26 consumer staple stocks with market caps greater than $10 billion that have a higher dividend yield than the 10-year Treasury. 26 large U.S. consumer staples companies with dividend yields higher than the 10-year Treasury. So, first of all, a couple caveats. Yields are extremely low for bonds in general right now, so the comparison's a little tricky. But consumer staple stocks are very stable. They have very predictable, not volatile cash flows and even stock price movements for that matter than other areas of the market like technology and things like that. And they also usually have a higher dividend yield because of those predictable cash flows. So his example that he talked about in this article was, hey, would you rather own, for the next 10 years, a bond that pays you these microscopic interest payments and then you get your money back at the end? Or would you rather own Walmart, which is a company that has raised its dividend for 48 straight years?
That's crazy.
And to me, what that says is, Tina,
There is no alternative?
there is no alternative to stocks, especially in the inflation world we're living in. So when you think about fixed income, now we just had an episode on bonds, so if you want to know how bonds work and how inflation's in
How
fact
exciting they are.
it's pretty exciting. It was actually a really good episode. 53 minutes on bonds, and no one fell asleep.
That we know of.
No one fell asleep that we know of. It's not been reported to the state highway patrolmen from people driving. But if you're in your autopilot Tesla, you don't worry about it.
That's right.
You can just enjoy it with your hands on the wheel, but autopilot mode. So anyway, low interest rates and high inflation are terrible for bonds in general, but dividend growing companies are great. So what this is telling me is that, in general, the numbers are saying that bonds aren't that attractive right now compared to stocks. They do have a place in your portfolio, as we talked about in that episode, for volatility purposes. But in terms of return, no. Stocks are the way to go.
Makes sense.
That's what I'm saying.
We've talked in the past, and understanding volatility, the different risks. Volatility and risk are not the same thing, and we've talked about them in the past. So, good.
Risk is really that you outlive your money.
That's the biggest risk for most people.
So risk is not that your money goes down before you need it.
Yep.
Yeah.
All right. My third topic, and this was one that was very exciting and I think relevant for everybody, is cybersecurity.
Wait, is this like, speaking of Tesla, is this like the bulletproof glass on the Cybertruck?
That's right. Cybersecurity. Throw a rock in it, may crack on the main stage when everybody's watching. But cybersecurity, and we're talking getting hacked, getting, any kind of your identity theft, accounts, transactions, viruses that, what do they call that? Ransomware, where your screens get locked and you got to pay money to get it unlocked.
In Bitcoin.
All that. I mean, that could happen to anybody. They're targeting just about anybody. And there's a lot that goes, again, a lot that went into it, and whether from a business side of things versus, personal. But the key takeaways I wanted to share were, one is if you're just aware and think through the actions, you can stop the majority of the initial kind of data gathering they're trying to do. So in other words, if you get a email or a text or even a phone call asking information, you're just not sure about it, if that little warning flag comes up like, just don't do it. Seems a little off, just don't do it. No company will get mad at you for saying, you know what, I'm not comfortable. Let me call back the number that I have.
Yep.
They'll be fine with that because they understand, all right? The people who will not like that are the ones trying to steal your data, and they want you to only talk on this line.
Right.
So if someone calls you or you get an email and you're just not sure about it, don't use that return number. Don't use the number down in the email address.
Use the one that you've used before.
Find the one. Yep. Find the one you've used, or look on your paper or wherever you have it, and call that number, explain what you have, and then ask to talk to somebody.
It's not
those little
science,
things. Those little things save a lot, because what they need is some information before they can do a lot of stuff. The other thing is, as frustrating as it is, change your passwords periodically. Don't reuse passwords. And if you get an alert that something, like for instance, if a website you use has their data stolen, make sure you change that password and don't use that password anywhere else. Those are the little things. There was the big hack on the utilities, the the oil company, and that was a result of a travel company's website being hacked. They used that same password in there, and it was actually a terminated employee. They just never scrubbed his login stuff.
Right.
It's horrible. It's like
crazy.
just the little things. But
Yeah.
for you personally, security is just take a little time to think through, is this the right email, and can I verify that somewhere else?
And there are just so many things that companies aren't actually going to ask you, either over the phone or on an email.
Yeah. Especially if you're not the one that initiated the call. If you're, for instance, if you call our firm or any financial institution, bank, anything like that, you call in, they're going to verify who you are.
Yes.
But if they're calling you, they should not be asking you those questions. And most places probably won't call you. They'll respond by letter or whatever. But, like we call our clients, a lot of banks call, ask questions, but they're not going to ask you for their social security on the phone. There's no reason why they need that calling you for anything. So just keep that in mind. It was very good, very interesting. The other thing you said is a big takeaway is nowadays, most cell phones, you can get unlimited data plans. He's like, don't use public Wi-Fi. He goes, you don't know who else is sitting on there. There's a lot of smart people that can steal data through public Wi-Fi.
Airports,
He's like,
terrible.
Use your phone's tethering where you can use that as a hotspot because the phone's data is a lot more secure than those Wi-Fi networks.
Oh, yeah.
And so that was his other takeaway. That's pretty easy for most people to just use a hotspot instead of jumping on public Wi-Fi.
Absolutely. My third article, which is an article again, is from ARK Investment Group. Now, ARK is an investment firm led by Kathy Wood, who's become very, very famous. She's all about innovation.
So ARK. Like Kathy Wood. Okay, gotcha.
She actually, it was named after the Ark of the Covenant.
And her last name is Wood.
And her last name is Wood, which... What was the type?
For wood.
Gopher wood. That's exactly what I was thinking. What was the type of wood Noah used to make the ark? Gopher wood. Even though that's a different ark than we're talking about.
Yes, totally different.
Covenant.
Offsite. Yep.
Gold.
Yep.
Anyway, so aside from that, Kathy Wood's firm, ARK, they publish research all the time. They're all about innovation. So one piece that they published recently that I read was that robot delivery of groceries could cost 40 cents per trip.
That's crazy.
Okay, so
what's the distance there?
You let me get there.
Okay, you tell me.
So companies that are already doing some sort of rolling robot delivery right now. Domino's, you get your pizza delivered.
Yep.
FedEx, Kroger, Walmart, some Chinese companies called Alibaba, JD.com, and Miutan. They're all using some form of delivery robots. Now, if you've been to Bowling Green...
I was going to tell you, I'm pretty sure Bowling Green has this.
It sketches me out. But
They're driving around these little things.
I know. It is freaky, but they're
It's
legit.
cool.
They're kind of legit.
I want to follow one or try one sometime, but
I know.
There's never that I'm in Bowling Green that I need to
deliver.
deliver.
They can get it to deliver from Bowling Green
all the way down
here.
Driving down 75, a little robot trucking along.
So recently, ARK thought sidewalk robots could get sidewalk food delivery down to 6 cents per mile.
Oh, man.
But they note that legal regulations may slow the rollout of these systems because a lot of neighborhoods and municipalities aren't super thrilled about having robots all over their sidewalks. Sounds like a tripping hazard or a lawsuit.
Man, you know what, though? You figure they got to be pretty durable, right?
You'd hope.
So, if I'm tired of walking and this robot's
hop on.
heading the same direction as me, I just hitch a ride.
It is, you could actually charge that. You could double dip.
Yeah, that's right.
You could double
pay
dip.
to go, and
You put a little scooter stand thing on
that'd
it.
be great.
We may have just also cracked
That's
the
it.
code on that.
That's
It's
crazy.
like ride sharing
But, okay, so
with a robot.
roughly, if they forget regulations, 6 cents a mile to deliver for these robots.
That's their super bullish
Yep.
case if everything went their way with taking regulations and stuff out of the thing. Now, so this was a little bit ago they published that piece, but now ARK says that a delivery robot for a company called Neuro could deliver for about 37 cents, while the same delivery for a human driver would cost $2.40. That is a huge
good
difference.
savings, yeah.
That's a huge difference. And they went on to extrapolate some statistics. If every household in the U.S. were to use robot delivery for groceries at the average of 1.6 trips per week to the grocery, which is average.
Those
for the-
half trips they kill me every
I know.
time.
It's where you get just candy or whatever on the way out the door. We're looking at a $4 billion market opportunity.
Wow.
And those numbers are even more staggering if you add in takeout and stuff on top of groceries.
It's true.
So I am a proponent of Instacart. It's not free, but, time is money. And I think if Instacart were to get onto this robot delivery thing... Now, I apologize in advance to the robot who has to deliver to my house because my sidewalks are so jacked up because I have a really big tree.
Fall over.
But that would be awesome. Start saving people some money.
I mean, I got 6 people in my house.
It's a big
Our
robot.
grocery, how many robots are following behind?
It's a Hyundai Santa Fe or whatever.
Like a train of robots.
Just a driverless car.
That's true.
So anyway, that is my third article. Lots of interesting things going on right now. Lots of innovation going on right now. Lots of just crazy things in the world and technology. But Josh, good trip. Sounds awesome.
I had a great time.
I'm still taking the highlight to be the lobster rolls for me. But I'm a foodie. I'm a foodie and I love lobster. So that's awesome. 2 reminders. Number 1, it's not too late to enter our second half stock
who doesn't
draft.
like blue cheese?
That's because blue cheese is rotten food. Like, why would I eat more rotten food than when it was original cheese?
Just telling you.
So we mentioned it earlier, but it's still not too late to enter our second half stock draft competition. Check it out. There's information on social media and our website how to do that. Number 2, as always, check out our free gift to you. It's a brief list of 8 principles of timeless investing, overarching investment themes meant to keep you on track to meet your long-term goals. That is free on our website. Josh, how can people help us grow this podcast?
Yep, make sure you subscribe. Every Thursday, you'll get our newest episode sent directly to you. Leave a review on Apple Podcasts. It's always great. Helps more people find us. If you have any thoughts, questions, or want follow-up from any of those crazy things we talked about, shoot us an email at hello@theinvesteddads.com. And then also, if you know someone who loves our last articles that we talked about, send them this episode.
All right. Well, until next Thursday, have a great week.
All right, talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.